Hello, today I will walk you through the solutions for question 1 from the mini case study on Seman Industrial Gas Corporation. Let's dive into each part of the question step by step. For part A, we start by preparing the schedule of expected cash collections for November and December. In November, we collected 75% of November's sales amounting to 255,000 ringgit and the 83,200 ringgit accounts receivable from October. Adding these two gives us total cash collections of 338,200. For December, we collected 75% of December sales, 270,000, and 25% of November sales, 85,000. This totals 355,000. For part B, merchandise purchases budget, we calculate the merchandise purchases for November and December. The cost of goods sold, COGS, is 71% of sales, which is 251,400 in November and 255,600 in December. We also need to ensure that ending inventory is 75% of the following month's COGS. For November, it is 191,700, and for December, it's 186,375 ringgit. By adding the desired ending inventory and subtracting the beginning inventory, it gives us the required purchases, 252,050 ringgit for November and 250,275 ringgit for December. Next, part C, cash budgets. In November, we started with 22,200 ringgit in cash, adding 330,200 ringgit in collections give us 360,400 ringgit as total available cash. After deducting 217,600 ringgit in cash payments, we end November with 142,800 ringgit. Similarly, in December, starting with 142,800 ringgit and adding 355,000 ringgit, collections totaling up to 497,800 ringgit. Deducting 273,450 ringgit leaves an ending cash balance of 224,350 ringgit. For part D, budgeted income statements. The budgeted income statements reveal net income. For November, sales of 340,000 ringgit, less expenses of 284,000 ringgit, yield a net income of 56,000 ringgit. For December, sales increased to 360,000 ringgit and expenses rise to 298,200 ringgit, resulting in 61,800 ringgit net income. Lastly, we prepare the budgeted balance sheet for December 31. Assets include 224,350 ringgit in cash, 90,000 ringgit in accounts receivables, 186,375 ringgit in inventory, and 963,600 ringgit in property, plant and equipment. Total assets amount to 1,464,000 ringgit, 325 ringgit. Liabilities and equity consist of 250,275 ringgit accounts payable, 640,000 ringgit common stock, and retained earnings of 574,050 ringgit, bringing the total to 1,464,325 ringgit.
Now we'll go through question 2, A and B. First, A, the direct labor rate variance. The formula for this is AH multiplied by AR minus AH multiplied by SR, where AH is actual hours and AR is actual rate and SR is standard rate. So using the data provided, AH multiplied by AR equals to 2000 hours multiplied by 7 ringgit plus 1400 hours multiplied by 7 ringgit and 20 cents. So we get 14,000 ringgit plus 10,080 ringgit, and we got 24,080 ringgit. Next, we will calculate AH multiplied by SR, where we got from the data provided 3,400 hours multiplied by 7 ringgit, and we got 23,800 ringgit. So the variance will be 23,800 ringgit minus 24,080 ringgit equals to 280 ringgit, which is unfavorable. So B, for the direct level efficiency variance, the formula is AH multiplied by SR minus SH multiplied by SR, where SH is standard hours. First, we'll calculate AH multiplied by SR, which is 3,400 hours multiplied by 7 ringgit, and we got 23,800 ringgit. And then SH multiplied by SR, where we got 800 hours multiplied by 4 and 7 ringgit for the standard rate. So we will got 22,400 ringgit. So the calculation is 22,400 ringgit minus 23,800 ringgit, and we will got 1,400 ringgit unfavorable. Next, we'll be moving on to calculate the direct material price variance. The formula used here is AQ multiplied by AP plus SP, where AQ is actual quantity, AP is actual price, and SP is standard price. So for iron, we got an AQ of 5,000, AP of 2 ringgit, and SP of 2 ringgit. So we calculate all that up, 5,000 multiplied by 2 ringgit minus 2 ringgit, and we got 0. For copper, its AQ is 2,200, AP is 3 ringgit and 10 cents, SP is 3 ringgit. So 2,200 ringgit multiplied by 3 ringgit and 10 cents minus 3 ringgit, and we will got 220 ringgit, which is unfavorable. So adding those two up, we will got 220 ringgit unfavorable. Finally, we'll compute the direct material quantity variance. The formula is SP multiplied by AQ minus SQ. We know that SP is standard price, AQ is actual quantity, whereas SQ is standard quantity. So for iron, its SP is 2 ringgit, its AQ is 3,900, and its SQ is 800 multiplied by 5, which is 4,000. So the calculation will be 200 multiplied by 3,900 minus 4,000, and we will got 200 ringgit favorable. For copper, its SP is 3 ringgit, AQ is 2,600, and SQ is 2,400. So the calculation will be 3 ringgit multiplied by 2,600 minus 2,400, which will get 600 ringgit unfavorable. So the total variance is 600 ringgit unfavorable minus 200 ringgit favorable, and we will got 400 ringgit unfavorable.
E. Overhead expenditure variance change. So this variance compare the actual overhead cost incurred with the budgeted amount based on actual hours work. So for the formula, actual hours times standard rate minus actual overhead. So 3,400 hours times RM3 minus RM12,000. So the answer is minus 1,800, which is unfavorable. So for F, overhead efficiency variance change. So the variance measure the efficiency of using labor hours, as overhead is applied based on direct labor hours. So for the formula, standard hours for actual production times standard rate minus actual hours times standard rate. So 3,200 hours times RM3 minus 3,400 hours times RM3. So the answer is minus 600 ringgit, which is unfavorable. So next, G, budget variant expenditure for fixed overhead. First, this variant show the difference between the budgeted fixed overhead and the actual fixed overhead incurred. So formula for this budget is budgeted fixed overhead minus actual fixed overhead. So 4,000 times RM2 minus RM8,800. So the answer is minus 800, which is unfavorable. So H, volume variance on fixed overhead. So this variance indicate the impact of production volume on fixed overhead recovery. So for the formula, standard hours for budgeted production times standard rate minus standard hours for actual production times standard rate. So 4,000 hours times RM2 minus 3,200 hours times RM2. So the answer is RM negative 1,800, and same, unfavorable.